one of the things that a lot of commentators will point to is the fact that we're seeing service industries such as the airlines and the hotels, which were particularly impacted by COVID and social distancing. We will start to see pricing pressure on the upside coming in those areas. The reality is, though, that they're a very small part of the CPI or the inflation basket, which is relevant to central banks when they make decisions around interest rates. A bigger part of it is situations like and contributors such as rent, and we're going through a cyclical moderation of that particular input into the inflation equation. So I think when we take all that into consideration, I'm not expecting inflation to be the big driver of outcomes this year. In saying that, I do think we will see interest rates, or the yield curve rather, continue to steepen, which was a condition that we talked about last year. And what I mean by that is that the longer dated maturities for bonds start to go higher, and that is something that we are seeing, and that will certainly catalyse some changes in the equity market with respect to different sectors which perform well and different styles that perform well. But overall, I think that central banks are likely to behave themselves during the course of certainly the first half of this year, and we'll still see strong quantitative easing measures being implemented both in places like the US. We've seen similar comments coming through from the Reserve Bank of Australia just last week, and despite the fact that the Australian economy is doing very well now, and we're seeing unemployment levels begin to peel back very quickly, despite the fact that participation rates are lifting and overall economic growth here looking increasingly favourable, they are still committed to their quantitative easing program in that market, and I think that's again just a real tailwind for the sort of outcomes we can see there with respect to growth and with respect to share price performances. So I think that's really good. So at the moment, we're just about to embark on the corporate reporting season in New Zealand, Australia, and also of relevance is the season going on in the US as well, which has quite an impact on the performance of shares in this part of the world. And so far, the numbers look good. We're really encouraged by businesses reporting, right across the spectrum in terms of the different sectors with respect to the outcomes that they're delivering relative to the expectations that we had going into that period. And this is quite a powerful dynamic for investors as they're looking to be rewarded by better than expected sort of outcomes coming from the companies they own. So I saw a comment about the earnings sentiment, if you like, in the markets, and one of the things that we're seeing at the moment is that the level of upgrades coming through relative to the downgrades coming through for the corporates we can invest into is at the sort of levels that we haven't seen for almost 25 years. So it's a very, very powerful sort of backdrop for equity investment at the moment. Now, where we're seeing the outperformance coming from, it's both in terms of the cost management and also in terms of which has been executed on very well by management teams. And we're also seeing it coming through at the revenue line. So because the economy has picked up at a pace quicker than had been expected, companies are enjoying much more productive environment for the services they sell, the products they sell, and as a consequence, the margins overall for the businesses are actually exceeding expectations. So that's really encouraging for me. When I think about the sorts of businesses and the sectors that we expect to do really well over the next 12 months, it's interesting when you think back to those sectors and those businesses which were, I guess, the main contributors to the profit recession that we went through 12 months ago. They will again likely be the ones that do particularly well in terms of contributing to the recovery that we will see over the next sort of 6 to 18 months. And so those are businesses and sectors like the financials, for example. So the financials are a large part of especially the Australian market, and that includes the banks. So when I think about the earnings outcomes that they went through during 2020, they were down by about 30%. Now, I would expect a huge amount of that to reverse as we move through this calendar year. So I think they'll do quite well. When I think about some of the industrials that were particularly sensitive to the social distancing measures, again, we would expect them to do well as we progress forward. And those are the businesses such as your airlines, your hotels, your casinos, those sorts of businesses will all do quite well during this period. So when we're looking to allocate capital, those are the sorts of things that we're looking to make sure that we understand, both in terms of the direction of those earnings and also the way in which the market has priced them at this point.